This is Trust Tuesdays. Again, every Tuesday we're going to be doing a call on trust, how to use trust, how to benefit from trust while you're alive, for asset protection, reducing your taxes, avoiding probate. Obviously, that's when you're dead, but there's lots of other uses, eminent domain, lots of different things that can be useful when it comes to setting up a trust, specifically a dynasty trust. So today we're going to talk about LLCs, large lawsuits coming. A lot of people call them limited liability companies, but for business purposes, there are lots of other ways to run your business where you can do whatever you're doing, but do a lot more efficiently. So we'll talk about how to use a dynasty trust instead of an LLC for your business and investments. So quick disclosure, the legalese here is, none of this is, tax financial advice. This is just a presentation. When it comes to your specific situation, how things are going to work out, that's kind of a more in-depth conversation that we can kind of have on the back end. But this is just 30,000 foot view educational information for you to kind of understand how these concepts work. Okay. Quick background on me for those of you that don't know me. Maybe you got an invite on LinkedIn, maybe we're first connections, second connections, whatever, Facebook friends or whatnot. My name is Stephan Bellholm. I'm a tax strategist out of Pinehurst, North Carolina, which is about an hour south of the Raleigh-Durham area. And what I do is I work with business owners, investors, and tax firms really all over the country. I have a whole team of forensic CPAs, tax attorneys, enrolled agents, and specialists that all we do is help people utilize these specialized tax structures that unfortunately are very unknown. A lot of people don't know how these things work. They've never heard of them, or if they have heard of them, they don't know enough about how it's going to work in their personal situation. And I think the big disconnect for a lot of people is they think you got to be a billionaire to take advantage of these strategies and these structures, and that's just not true. Okay, and we'll kind of peel that as we go through Trust Tuesdays, different concepts. But we help people in all 50 states, so it doesn't matter where you are when it comes to these estate and tax structures or specialized tax structures. And these can range from private foundations. There's a lot of different charitable strategies we use, donor advised funds, trust. We're going to talk about specifically today the dynasty trust, because that's a very powerful and dynamic structure that a lot of people in business or that investors just really don't know how to take advantage of. So that's what we're going to talk about in this call. So just to get right into it, LLC. Who here has an LLC? Does anyone here have an LLC? Raise your hand, say something. Again, you can turn on your camera. Yeah, you have an LLC? How long have you had that LLC for?
At least 10 years. I have many LLCs. I have like 40 LLCs.
Okay, perfect. So you're used to the whole LLC game, right?
Yes, it is all of them single purpose, single member LLCs.
Single member LLCs. And that's where all LLCs are going to default to, right? If it's just you, it's going to be a single member LLC. Now, the advantage of an LLC is that you can choose your tax election, right? You can choose to be treated as a single member or as an S Corp or a C Corp or whatever. But at the end of the day, the membership of that LLC is going to be held by you, right? It's going to be held by an individual or individuals, right? And so that's where the liability is limited, because what happens is at the end of the day, every LLC is either owned by someone or they're the director of the LLC, right? Or the owner operator, officers. There's all these different things that you can do, but it's 2024. People have gotten a lot more savvy and know a lot more stuff when it comes to trying to sue people. Unfortunately, we live in a very litigious society. So this is where, it can, the whole concept of piercing the corporate veil actually happens, is because, yes, you have an LLC or you have an S Corp, but you're not that well protected, because at the end of the day, if I want to sue you, okay, I can sue the LLC, I can sue the corporation, or I can sue someone else. I can find out who's kind of behind the scenes there. And the biggest reasons why the corporate veil gets pierced is because most LLCs aren't actually operating as entities, right? They're not doing their meetings, their minutes, and this is where the courts come in and they can say you're an alter ego. Okay, have you ever heard of that term? Has anyone heard of that term, alter ego?
Yes.
Okay, so so alter ego is essentially, if you haven't heard of it before, is essentially when the courts say, all right, you think you're operating as a business, but you're not actually operating as a business. So we're not going to treat you as a business. Okay. And on average, this is from I think Wake Forest University and Duke University. I can't remember which one did the study about a few years ago, but on average, the states and federal courts pierce LLCs about 40% of the time. And it happens all the time, which is why, again, LLC stands for large lawsuit coming. So if you have an LLC, that's great. It does provide some layer of protection, but not a whole lot of protection because of that corporate veil. And when we look at the brief history of entities in the United States, most people don't realize that S corps only go back to about 1958. Okay, the first LLC wasn't started until 77, and I think it was Wyoming. So before this, most people here are used to operating LLCs, right? You have an LLC or an S corp, whatever. That's kind of what you know as far as a business is concerned, or your investments. But prior to this, right, prior to those two dates you see here, businesses were run by either individuals, or run by themselves, corporations, or by trusts. And so that's really what I want to unpack today, is how do we actually use trust from a business standpoint? Because most people think of trust as a way to avoid probate, and that is one way to use trust. That's the most important way at the end of the day. But there are other ways that you can use trust. Specifically, we're going to talk about the dynasty trust for business purposes or your investments. Has anyone seen this before? Does anyone know what this is?
Yes.
What is it? You're the only one that seems to be talking, so I'm gonna let you do the talking.
You send all the lenders and other things. You write the EN number, and just basically it says that this company is responsible for the tax payment.
Yep. Yeah. So this is anytime you're an independent contractor, or you're in sales, or you're an investor, you fill this out, and this is how they know who to pay for tax purposes, right? Who the money goes to. You fill out your ACH, they cut the check, but for tax purposes, this is who it goes to. Most of the time, people are going to choose either individual, sole proprietor, maybe LLC. But if you look right there, that's highlighted, what do you see, Furkan?
Trust or estate.
Trust, right? Trust estate. That's on every single W-9. It has been since the history of W-9s. But that is not an option that most people choose, okay? Because they don't understand how trusts work for business purposes, okay? So I'm going to kind of get into that, and I'm going to get into that through drawing. So you're going to see my artistic flair, which is not so good, but it is what it is. So I'm going to kind of draw this out, and I want to go through a few things with you guys and some scenarios. So Furkan, since you're the only one that's talking, I'll kind of go over how this would work in your situation. Okay. Here we go. Now, first off, let me start by saying this. Have you ever heard of a dynasty trust? Do you kind of understand what it is, or know what it is, or anything like that?
We heard a lot about trust, but we never heard about the dynasty trust. We know what trust is. Dynasty is the new word I just heard.
Yeah, it's not a new word, actually. It's been around for a long time. So the basic concept of a dynasty trust is that this is a trust. When you typically have a trust, so I'm going to draw this out here. Can everyone see my screen? Can you see my screen? The whiteboard right here?
Yep.
Okay,
yeah.
Perfect. All right. So typically the way that most trusts are set up, right? You're going to have, assets in here. You're going to put your real estate in here. You're going to put your money, insurance, life insurance, vehicles, anything like that. And then at the end of the day, when you pass away, right? So this is you, Furkan. I know it probably doesn't look like you, right? So when you pass away, when you're dead, right? All of this is going to go to your beneficiaries, right? You have beneficiaries. and then they inherit all of this stuff, right? But the issue with that is that when they inherit everything, it goes into their personal name. Okay, so it leaves the trust estate. So the trust is like a separate entity. Okay, it has its own EIN, does its own bookkeeping, its own tax return, its own bank account, everything. But typically, what will happen when people die, when you're dead, all of that goes to the beneficiaries, and then this trust is no more. Okay, so what a dynasty trust does is it kind of flips that on its head. It says, okay, when you're no longer here, let's keep this trust here. Let me use my eraser. Let's keep this trust alive. So you're still going to die one day. You don't know how, we don't know when. But when you die, we're still going to keep this trust alive, right? And your new beneficiaries, instead of the money going to them, they're going to be what's called the trustees. Okay, they're going to upgrade to become the trustee, just like you. Okay, and so for that reason, there's no distribution from the trust, and all the money inside the trust, all the investments and the assets and everything can keep on growing and growing and growing and growing and get bigger and bigger because there's no taxes. Okay, there's no taxes because there's no distributions from that trust. Okay, have you ever heard of the concept of a trust fund baby? Have you ever heard of that before? Heard someone been called a trust fund baby?
Yeah.
Yeah. Well, this is what they do. Okay, they don't actually dissolve their trust. They keep the trust going and going, and so therefore there's no tax, and they can use the money inside the trust to pay for a bunch of different things. So this is where the trust fund baby concept goes on steroids, because now, okay, you're the new trustee, right? Your kid's the new trustee. Their kids, you can use the money inside the trust to pay for college. Okay, they want to buy real estate, they want to buy a property, the trust buys it. Okay, they want to buy a car, the trust buys it. Anything that you can think of that's a reasonable trust expense that the trust can pay for, it stays inside the trust. There's no distribution, but there's no tax either. So any type of investing, from real estate to stocks, crypto, anything you can think of, it stays inside the trust and just keeps getting bigger and bigger for generations. And that's where the term dynasty comes from. Okay. Does that make sense?
Yes, very much.
Okay. So when we're talking from a business, someone had a question?
Yeah, this is Christian.
Hey, Christian. Hey, what's good?
So I have a question. You mentioned like buying property in the trust. You know, when you buy property as an individual, you have to qualify with income to qualify for the loan. So how does a trust qualify for a loan in order to buy property within the trust?
Good question. So a few different things. Remember, and this is, and I'm glad you're talking about this, because these are things that we're going to continue to talk about, every Tuesday and expand on. But remember, the thing to understand with these trusts is that, let me just clear this out, is that when you're setting up the trust initially, right, there's no money, right? So trusts initially are just, it's a shell, it's a silo, right? You're setting up the trust, you're appointing the trustee and the beneficiaries, but there's nothing inside the trust. So once you start putting things inside the trust, that's when you can start investing. So for example, real estate, right? If you have investments, let's say right now, let's say you have a stock portfolio or a real estate portfolio right now, okay? You're going to take that real estate from your personal estate right here. You're going to sell it over to the trust, okay? But if that has a capital gain, guess what? That capital gain is not taxed inside the trust, okay? Not taxed inside the trust. So now you have a whole bunch of money inside the trust, right? That you can use to buy. So let's say that you bought it for 300,000, but now it's worth $1 million, right? It's worth 1 million. Okay. If you sold it in your personal name, you're paying capital gains tax on that, right? But now we're having the trust do it. So now the trust has the $1 million and it's not taxed. Okay. So now the $1 million is inside the bank account of the trust. It's not taxed. You can use the money inside that to go purchase new real estate in the name of the trust. Okay. So that's how it works. Initially there's no money inside the trust, but you're going to transfer assets, investments, things like that over to the trust, not pay tax. You have the asset protection, which is, we're talking about LLC, large lawsuit coming. That's really the focus of this, is that these trusts give you ironclad asset protection because they're separate entities that don't pay any taxes and they don't distribute income to beneficiaries. So unlike my LLC, right, where my LLC is owned by members, right, there's ownership, right? And this is the whole concept of these dynasty trusts, is own nothing, control everything. And that's a very, very important concept to understand, is because with over here in your personal bucket, you use a red marker, you own everything, right? Over here in this bucket, there's no ownership, but there's control. Okay. So that's really the core concept between doing things in your personal estate or even an LLC, because a lot of people, again, they set up LLCs and they think it's something separate, but it's not. You're the owner of that LLC, right? Like Farkhan, you're a single member LLC, you're a single member. I call it a disregarded entity. Even if you set up an LLC and have it as an S corp, okay, you're a member of that LLC, right? You're the principal or whatever. So that's the thing to kind of understand, is that when you're using a trust, you're not owning anything, but you do have control as a trustee. Okay. But good question, Christian, about real estate and how that works. Is, yeah, you're getting everything, you're selling everything over to the trust, money's in the trust, now the trust can purchase things. But you can still buy things in your personal name, okay? Because you're going to have your own credit and all that stuff. So you can continue to do things in your personal name. But once you have it, don't keep it there. As soon as you can, sell it over to the trust. That's what's going to give you that asset protection.
I have a question about that.
Yeah.
So if you were to sell it to your trust, would you have to wait until it appreciates to 1 million? Or would you, like, if I was to buy my first investment property, and then transfer it over to my trust, should I wait like a certain amount of time?
Nope. Nope. That's a good question, but you don't have to. There's no seasoning required. So when we sell everything over to the trust, let me just clear this out real quick, and I'll get back to the LLC thing. When we sell everything over to the trust, we're selling it at cost. Okay, we're not creating a gain. So if I bought a property, let's say it's 300,000, and I put 100K in improvements in, right? My basis is 400,000. Okay, that's my cost. Now, if I take depreciation, and this is the thing when we talk to people in real estate, if you've taken depreciation, you've done cost segregation or bonus depreciation or anything like that, we have to take that into consideration. And that's where it sucks, because for every gimme, there's a gotcha, right? It's great on the front end. You can save some taxes when you take that depreciation, but when you sell, that's when you have capital gains, you have depreciation recapture, right? All those that makes your tax bill even higher. So if you've taken depreciation on a property, you have to take it into consideration, but you're not creating a gain when you sell it over to the trust. So even if that property is worth $1 million, we don't have to sell it to the trust for $1 million. We can sell it at cost. Okay. And so that's how we get properties over to the trust. And the cool thing about that is, now that property is in the trust owes you $400,000, right? Because you sold it over to the trust, and the trust owes you money. So that $400,000 ends up being what we call a demand note, or a note payable in the trust account. So the trust actually owes you money, and you already paid taxes on that. So you can take money out of the trust and not pay tax if you wanted to, for non-trust expenses, what we call food, fund, and fashion. Okay. So there's different things, but the long and short of it is that we're selling everything over to the trust. We're not selling it. You don't have to wait for it to appreciate in value. you can sell it over right away, but you're selling it at cost.
Yeah, but it sounds like you're selling it at cost, but there's no mortgage on it. The original homeowner, maybe he owes $200,000 still on the house. When he transfers it, who pays that? The trust doesn't have any money.
The trust does once it has money. So
yeah, but it doesn't.
Yeah, it doesn't initially, but it's going to have money. And that's kind of what we're talking about LLCs, because these types of trusts are for income producing properties, income producing investments, real estate stocks. So if you have a property that's, or you don't have anything that's generating income, this isn't a strategy that's going to work for you.
So in other words, you can't protect your personal house then.
You can.
Well, you're just saying it doesn't produce money.
So I think you're conflating two different things. So if I have my primary residence, right? That's a good question. So let's go with the primary residence. If I have my primary residence, I can sell it over to my trust and have it owned by the trust. Okay. And I can sell it at cost. But yes, like you said, that there's still a mortgage there, right? There's property taxes, there's insurance, there's, the roof guy, the pool guy, all that. Those become a trust expense now. Okay. But if my only asset is my primary residence, I don't have any other investments, I don't have a business, right? There's nothing that I can put inside the trust to avoid taxes. So if my only income is W-2 income, this is not going to work for you. Okay.
Okay. What I heard people say, what they've done is when they've put the house into the trust, the trust then signs a lease with the property owner or the original guy, because obviously he's living in it. Somebody has to pay rent. So that's correct. Structure pays to the trust, so the trust can then pay the mortgage and all the expenses.
That's correct.
That make sense?
Yes. So there's what we call a PUL, a personal use lease. Because if you're, like you said, this is your house, you're living in there, you have to pay some rent. So that rental income goes into the trust that doesn't pay any taxes on it. But to pay the mortgage, right, to pay the property taxes, the insurance, all those expenses generated by the trust, you need money in the trust. Okay. And so that's when we're talking specifically today about LLCs and businesses, business income, investment income. That's when you need to have those type of investments and stuff to make this work. If your only source of income is W-2 income or a pension or Social Security, this is not going to work for you.
Okay. So the other question I have is look at the Kennedys. They have like 1,000 trusts. The reason being, they said, is if you put a house into it, along with other assets, if somebody gets hurt in the house, they can sue everything within that trust and take all the assets of the trust.
Not these types of trusts. No. So I think, if you have a true dynasty trust that has the asset protection that you need, nobody's going to be able to touch anything inside this trust, because the trust itself doesn't even own the property. So in other words, and don't want to go too down the rabbit hole, but it's a good question, and good concept that you brought up. Remember there's three parties of the trust, right? You have the grantor, right, who sets up the trust. You have the trustee, and then you have the beneficiaries. You actually have another party that's called the trust administrator or trust overseer, and this one can actually fire the trustees. So we're just going to call TA for right now, okay? But long story short is when properties are held over or sold over to the trust, the title. So when we talk about title, because there's three different parts of an asset. The title is what is held in trust. The title of the property, so the name of the property is whatever the trust. But the actual equity, the actual ownership, because ownership is by contract. Okay, everything is in this country is done by contract. So the trust itself holds the title, but the assets are held in escrow. And it's held in escrow for the benefit of the beneficiaries. So the trust actually doesn't even own the property, the beneficiaries do. but we're not distributing money to the beneficiaries or property to the beneficiaries because we don't have it for generations.
So if a lawsuit arises on an asset within that trust, how does the trust segregate the assets so that nothing else gets hurt?
This is what's called the spendthrift provision. And so the spendthrift provision, and I'm writing this horribly, so excuse my handwriting, but the spendthrift provision is exactly what I just explained. It's what separates the title of the property from the actual equity. It's a term called equitable title. Okay. So when you have equitable title, you own something, then you can be sued. Then someone can take it from you. But what the spendthrift provision does is it separates the title of the property from the actual equity part, the ownership part. And we do that by contract. So when everything's done, there's an actual notarized bill of sale, there's a deed, there's a purchase and sale agreement. This is a legitimate sale when we're selling it over to the trust. We're not gifting it. Okay. And that's something to kind of understand in the variances between, different trusts. But to pay the mortgage and expenses and all that stuff, again, you have to have income or generated inside the trust for it to be, not taxable, which is, the whole benefit, and then pay all those expenses. Okay. And so that's where and I just want to kind of wrap up here because I know we're pressed for time, that's where when we can take advantage of using a trust instead of an LLC, right? Because the LLC, right, when we have an LLC, the LLC is going to pay taxes in some way, form, or fashion, right? It's either going to be a single member, S Corp, C Corp, partnership, right? All these different ways, but it's going to go back to your personal estate, right? It's going to go back to ownership, which is no bueno. Okay. So when we use a trust, we can have your business operations or whatever you're doing, your real estate, commissions, you have a retail store, you're a physician, doesn't matter. We can have the trust operate that business instead of an LLC. And so the typical way that we would do this is use what's called a dual trust structure. So we're going to have what's called a business trust, and then we're going to have a personal trust or beneficial trust. And essentially, this business trust is going to operate no differently than an LLC. So you're going to pay your expenses, vendors, invoices, all that stuff is going to be done through your business trust. But that net income, so let's say that net income at the end of the year after all your expenses is $500,000, okay? That $500,000 is going to be distributed to your personal trust, to your beneficial trust, which is where all the assets, all the real estate, all the money is. You don't have anything. There's no assets in this business trust. It's literally a flow through, just like an LLC. So at the end of the year, that net income is going to be distributed to this personal trust, to this primary trust or family trust, as an extraordinary dividend. Okay. And as an extraordinary dividend, it would typically be taxed. But since we're going to make a declaration, then it's not going to be taxed. Okay. So it's because it's going to hit this personal trust. If it were to go to your personal estate, that's 100% going to be taxed, but we're not going to do that. So that's one of the most typical ways that we use a business trust for active income when you have a business and things like that. If you have real estate, it's going to depend on how you're running your real estate. A lot of people will do rental properties. So if you have rental properties, you can have all of your rental properties. You can have 25 rental properties inside your beneficial trust. Okay. And all that rental income is going to go in. And because it's passive, you're not going to pay taxes on it. Okay. It only works with passive income. These trusts only work with passive income. So that's why I was explaining before. If you have just W-2 income, you have, Social Security, pension, stuff like that, it's not going to work. You have to have some type of, passive investment or business or whatnot for this thing to kind of work.
Stefan,
Yeah.
real quick, would you mind illustrating if I have rental properties, right? On a whiteboard illustration, and I sell them to the trust at cost, and then I have those investment properties, I want to sell those. So then I have the trust sell those properties, the property realizes a capital gain, and show how that capital gain is allocated to the corpus of the trust. And now there's money in that trust to go and purchase other properties to grow exponentially. Can you just show that? My
Yeah.
personal estate, I have investment properties.
Yeah, I went over that before with Christian. I don't know if you think you might have missed it, but yeah, I mean, what Michelle is explaining is exactly kind of how this works from a 30,000-foot view of why a trust, and 99% of the time makes a lot more sense than an LLC, is because we're taking all these rental properties that you have, and again, most people, their personal name. Right.
Or just investments. Maybe I'm doing a fix and flip and I have it in my personal name right now.
Yeah. Or, and this is where I'm going to put LLC, because, right, LLC is still in your personal estate, right? So the thing to kind of understand here is when we're selling everything over again, we're selling at cost, sell at cost. And once the property is in here, so let's say again, that was, 300,000. If it's worth $1 million, right, we're going to sell that. The property's in the trust. Now that $1 million, that gain, that capital gain, is going to be part of the trust corpus. Sorry for the bad handwriting. But now we have $1 million in the trust that, again, yes, we can use to go buy more real estate, buy more properties, buy more crypto.
So it would be like a $700,000 capital gain would have been realized on that $300,000 property. If the trust sold that $300,000 property, there would be a $700,000 capital gain realized. Allocate that back.
Exactly. $700,000 capital gain, not taxed.
That's right. And then yep. I would have $700,000 in the corpus of that trust to go and purchase more properties, or, pay for the other properties and it sold for $1 million.
Yeah.
But
so now we have $1 million.
Capital gain was.
Oh yeah. So now we have $1 million in the trust.
Yeah. Good. Yeah. Thank you.
So as a mortgage broker, if I would look at that and going, if you're selling, quote unquote, selling your property to a trust, the mortgage has to be paid off and a new mortgage has to be formed. How do you do that?
So you're probably thinking about the due on sale clause. And with these trusts, the way there's something called the St. Germain Act. I think it was in 1988 or 87 that was passed. So when we sell everything over, so let me just go back here. It's a good question. When we're selling everything over, again, notarized bill of sale, purchase and sale agreement, deed, right? Warranty deed, quick claim deed. Most of the time, it's going to be a warranty deed. But if it's a personal, we're going to do a quick claim deed, right? Because this is my property. So that deed is, all of these transactions are private transactions. That's the kind of thing to understand. So we don't have to file the deed with the county. So the county's none the wiser. That notarized bill of sale is what allows the trust to legally pay for trust expenses, property taxes, and things of that nature. Okay. Most of the time, mortgage companies are not going to, even if I did file the deed, okay, most of the time, mortgage companies are not even going to do the digging. And I've talked to mortgage companies that said to me straight up, we don't check because it's not worth it. It's not worth our time to go through and check. As long as the money's getting paid, the mortgage is getting paid, we don't care. But if they did, and they said, hey, we're gonna enforce due on sale, because this is not only is it it's a dynasty trust, it is a non-grantor. And again, that spendthrift provision, that's really the key thing. Because it has a spendthrift provision, it's also known as a spendthrift trust. that exempts it from the due on sale clause. But we don't have to file the deed in the first place. So the mortgage company is not going to know.
So if somebody comes after and sues you, an attorney finds property in your name because the deed's never been filed.
Yep.
That would create quite a legal hassle and basically could encumber and cloud the title on the property because it still shows in your name.
It doesn't matter. I sold it. I have a notarized bill of sale, a contract. Everything's done by contract. That's the thing to kind of understand with these trusts, because these are not statutory trusts. We're talking about statutory trusts like Delaware Trust, Nevada Trust, Wyoming Trust, things that are creatures of state legislature. That's one thing. But these are what are called non-statutory trusts. So they go by a whole set of different rules. But that notarized, so if someone sues me, that's great. It can still show on the county, it's showing in my name. But guess what, Judge? I have a notarized bill of sale. I sold this property 5 years ago to my trust that I don't own anything for, and I'm not the beneficiary of it. So it's kind of hard to wrap your head around if this is kind of new concepts, but that's the dynamics of how this.
So you can't be the beneficiary of your own dynasty trust.
No.
Okay.
That would invalidate the protection. So, and again, we'll talk about these things every Tuesday and break things down. But yeah, you're only the trustee, so you have control, right? But you don't own anything, and that's the big thing to kind of understand with this is own nothing, right? Control everything.
Yeah, that's the Rockefellers. That's the
Rockefellers. That's the Kennedys. That's the Gettys. That's the Bushes. That's me. I have this trust. Got this trust a few years ago, and I didn't know about these things. When I first got in the tax business, because they don't teach this stuff in tax and accounting. They don't teach complex trust accounting. The idea is you have to be multi-gazillionaire for these things to work, but it's not true.
So, Stefan, are you going to be doing any more of these type of little seminars?
Yes, every single Tuesday.
How do we find out about them?
So, good question. So, what I'm going to do is I'm glad you asked. I'm going to put my email in the chat, and I want you to make sure that you send me an email. We actually have a 2-hour, it's a little bit over 2-hour masterclass training, free training on the Dynasty Trust strategy, this specific strategy that goes way into the weeds, into the details and everything. It should be done in the next 2 weeks. So what I'm going to do is I'm going to put in the chat my email, and I'm going to also put in Amanda's email. She's my office manager. But send me an email first so you can get on the email list, or send clients or anyone else that that would be interested in this on the email list. And then send Amanda an email to get a copy of the 2-hour masterclass when it's done in the next few weeks. But yeah. So that's my email. And then I'll put Amanda's email in here. But those are all good questions that you have. And when you kind of start to break this down, it'll make more sense.
Yeah, I got a lot more questions, but I have to run, so I'll grab you.
Sure. So cool. Any other questions? Want to go into some more drawings? Anyone else? Furkan?
Okay, now we have those emails. Do we send you an email requesting future information?
Yeah. Just send me an email and I'll get you on the email list for the Trust Tuesdays. Because we're going to be doing this thing every single Tuesday, talking about different concepts of the trust and how it works and stuff like that.
So I'd love to learn from you. Thank you, Stefan. I got to go.
No problem. Thanks, Paul. All right. Anyone else? Any other questions? Isabella, Christine, Furkan, Christian?
Yeah, I have a question. This is Christine.
Hey.
Yeah, hi. We spoke in the past, but thank you for Yeah. So with the dynasty trust and then just like a regular
Sorry.
set up to protect, people just have personal trusts to keep yourself out of probate. Let's just put it for simplicity. So it's either
Yep.
those are set up. So what's the difference? Is it just in the verbiage that's makes it different? Like what's the structure setup that's really making this different than the other?
Yeah. So yeah, it's a good question. It's a lot of stuff. So
A loaded question,
it's
but I just
no. It's a good question. So I think the main thing to kind of understand is, so every trust, all trusts are basically the same. They're contracts. The difference is going to be what's called the provisions, right? The components of the trust, right? So the to kind of break this down versus a living trust, most of the trusts out there are going to be your living trust, revocable trust, grantor trust. There's different names of them. So the dynasty trust, really what separates it is most living trusts, revocable trusts, all that stuff, they're statutory. Okay. So what that means is they're creatures of state legislature. So you go and get a trust in Florida, that's a Florida trust. Get a North Carolina, that's a North Carolina trust, right? Every state has different rules and regulations regarding trusts and how they're set up and provisions and stuff like that. And you have to abide by those. Dynasty trusts are non-statutory, so they don't deal with any state changes or anything like that. A lot of people set up trusts in different states like Wyoming, Nevada, North Dakota, whatever. These trusts are purely based off of contracts, okay, which is what the country is based off of. Contract law, everything is a contract. Insurance, you buy a property that's, you're signing a contract to get a mortgage. So it's purely based off of a contract law. So the provisions of the trust are basically whatever the trust document says, for lack of a better word. So that's kind of the first thing. The second thing is that the living trusts are revocable, meaning that you can take a property and put it in your personal name and take it out and put it in the trust name as much as you want, because you're just gifting it. Which gives you some flexibility, but it doesn't give you any asset protection because it's technically not part of a trust estate until you die. When you die, yeah, your heirs avoid probate. Everything goes to the trust. At that point, it becomes irrevocable. But while you're alive, it is still part of your personal estate. So the dynasty trust is irrevocable. So once you put something inside the trust, that's it. You can't take it out of the trust. It's irrevocable, however you want to say it. The other part is most of these trusts are grantor trust, meaning that you're the grantor, you're the one setting up the trust. And sometimes you can be the beneficiary, as Paul said, you're not the beneficiary. Yeah, some people do that, and you can do that, but you don't get any asset protection or tax benefits. These trusts are non-grantor, which means that you're not the one setting the trust up. This is the whole thing with alter ego with LLCs, right? LLCs get sued a lot because, if you're a single member, you're operating, by the seat of your pants. You're not really a business. You think you're a business, but you're not. And it's you that's running the show. So the non-grantor provision exempts you from any alter ego issues, because alter egos can happen with trust too. Okay. So that's the other thing. It's someone else besides you that's not related to you that's setting up the trust. And then the biggest thing is from a tax standpoint, I can go into all the provisions that would take us, another 30 minutes, is most of these trusts use what's called the simple tax code, meaning that once income, if I have a property and I put it in the trust and, I'm generating rental income, all that rental income is going to get distributed through the trust at the end of the year. And it's going to show up on my personal tax return or the tax return of the beneficiary, whatever. Because it's using the simple tax code. It's actually called simple. versus the complex tax code for trust, which does not require a distribution. So I can have all my property in my rental properties in the trust, and let's say I net 25,000 at the end of the year. I don't have to distribute that and pay taxes. I can keep that in the corpus of the trust and keep it growing and growing, and all that stuff. So those are kind of the main things. There's about 8 different provisions that go in detail, but that's
so
the
dynasty is there's no tax filings or anything for the dynasty. Do you have to keep books? Like what?
Yes, so there is tax filing. So you do have to do a tax return. This is going to file what's called a 1041 tax return. So you do have to, file a tax return. There's books, there's, P&L, a balance sheet, so bank accounts. So it's no different than operating an LLC. But the whole concept is I could have $1 million worth of capital gains or any other type of passive income, real estate, stocks, whatever. And I don't have to distribute that income. So therefore I don't have to pay taxes legally on that income.
So would that
Okay,
is that similar to a business trust, or is that what some people call a business trust? Or
well, yeah. So you can, what a true business trust is going to actually distribute at the end of the year. But the way we use it is, and this really depends on how your business is set up. Do you need licenses? There's a lot of people that have certain licenses, in real estate, or they're physicians, whatever. And some industries won't let you operate through a trust. But for the most part, a lot of people, they can operate through a trust. So if that's the case, then they can do all of their business activities. Again, going back to this, you mind if I erase this real quick? Okay. You can operate your business, use a business trust, and do the same thing. Make sales, pay expenses, vendors, all that stuff, payroll, and any of the net income. So net income will not get distributed to you. Okay. If you do that, then you're paying tax, right? Yeah. That's taxable. That's a taxable event. So what we want to do is set up a separate trust, and this is really your core trust. This is what we call, the main dynasty trust. They're both essentially dynasty trust or family trust, whatever you want to call it. But this is where all of your assets, your vehicles, your properties, your money, all that is in here. This is literally a flow through. Okay. So you're not keeping any of your stuff, your toys in that. You're just using this for your business activities. So that net income would just get distributed to this trust, because this dynasty trust would be the beneficiary of the business trust. That's how this works. Okay. So yeah, so now you have that money and you can use it to go, buy more toys, buy more investments, all that stuff, but you're not paying any tax on that. Okay. So yes, that's kind of how that works.
Okay.
Hopefully that makes sense. But again, make sure you tune in every Tuesday. I know we're gosh, 50 minutes. Supposed to only be 30 minutes, but hopefully this was informative. You learned a lot. There's gonna be a lot more stuff, but I would make sure you send an email to Amanda so she can get that masterclass to you when it's done, because it'll make a whole lot more sense. A lot of this stuff that I went over today.
Yep. Okay.
All right.
Thank you.
Cool. All right, guys. I think that's it. Hopefully you learned a lot. Again, make sure you send an email to myself and Amanda. If you register this, we have your emails anyway, so we'll be reaching out to you. But tune in for the next Trust Tuesday. We'll go into more detail with stuff. And if you know anyone, friends, family, clients, whatever, have them join as well, because I'm sure they'll glean a lot of things as well. All right. Y'all have a good one.
Thank you.
You're welcome.